state income tax, it's a winner, because you pay no tax. So we're just going to go through this presentation, and if you have any questions, feel free to raise your hands, please. Stop me, or you can write down the questions and we can go through it at the end. The purpose of the presentation is just to give you an introduction of the provisions and also what an opportunity zone is. And at the end, we'll do a comparison with 1031 exchanges. And can you write down the questions so we can go through the presentation pretty quickly? It's a lengthy presentation. So the Tax Cuts and Jobs Act of 2017 is the tax law that was enacted by Trump at the end of 17, which basically changed the tax law, and they provide procedural rules for designating qualified opportunity zones and the related definitions. These provisions are aimed at making people invest their gains in economic areas that are underserved and distressed communities. They call them qualified opportunity zones, and they provide federal tax benefits to taxpayers who invest their capital gains in these areas. So that section 1400Z1 is the designation of the opportunity zones. And then subsection 1400Z2, it is basically the procedure where you can defer the gains to the extent of the amount that you invest in an opportunity zone fund. This is just a general description. What are the advantages of getting into an opportunity zone? First, you can defer the inclusion in income of certain gains. And in this instance, you have all kinds of gains. You have short-term capital gains, long-term capital gains, not only gains from the sale of real estate, gains from the sale of artwork, stocks, bonds, mutual funds, anything, tangibles, intangibles. If you invest that gain amount in an opportunity zone fund. So we call it qualified opportunity fund. The second thing is that you have 10 years to defer the gain recognition. So in other words, let's say I had a gain in 2018. I'm investing timely in an opportunity zone fund. I don't have to pay the tax until December 31, 2026. So if I can invest that money in a fund, and let's say I convert it to a cash flowing business or a cash flowing property, I can pay the tax from the cash flow of the business. I don't have to break that, like let's say I have a $10 million gain. I have to pay 25% tax, $2.5 million to the federal government, $1 million to the state. You pay the $1 million to the state, but you pay the $2.5 million at the end of after December 31, 2026. So that's a 10-year deferral. This is a definition of what a qualified opportunity zone is. Basically, what happened is that the opportunity zone is a population census tract that's a low-income community as designated by the chief executive officer of the state. In California, it's Gavin Newsom, so he's the governor. So he's the one who designates the zones, the census tract, as opportunity zones. The proposed regulations that came out in last October and this April, they provide rules that allow a corporation or partnership to self-certify itself as a qualified opportunity fund and be able to invest those gains in these opportunity zones. And this is a further definition of an opportunity zone. It's a low-income community that's designated as qualified opportunity zone. Forget about the certain determination period because this has already been done. As we discussed, the governor certifies that tract as an opportunity zone, and then the Treasury Secretary approves it for federal income tax purposes. And then if they change their mind and say, okay, this is an actual case we're dealing with, we have a piece of property that is going to be developed into apartments, and it's on R3. The next, the adjacent piece of property is on C2, and it's in opportunity zone. So they asked me to contact the government to see if we can, they bring this R3 into the opportunity zone. And the government said, no, you have to go back and talk to the governor of the state of California or the